I'm Steve Garth. I work with the War Hunt team, sitting on the investment committee.
The conflict between Russia and Ukraine has been going on for some time, but just in the last few days, Russian troops have entered Ukraine and taken control of that country. Now, this short video is not about the geopolitics of that situation, but we just want to explore what this might mean for investments going forward. First of all, why is Ukraine important? Well, Ukraine is the second largest country in Europe. It has a population of over 40 million people. It's fourth in the world in terms of the total value of natural resources. First in size in terms of land used for growing crops. This means Ukraine can meet the food needs of more than 600 million people. So Ukraine is important. So with that, we would expect the major economic consequences of this conflict to be rising food prices and rising energy prices. Now that will both play into greater inflation, but also potentially slower GDP growth in the world. When it comes to food, any interruption to the flow of grain out of the Black Sea region is likely to have a major impact and add further fuel to food inflation. And similarly, energy markets are likely to be disrupted by this conflict. Europe relies on Russia for around 35% of natural gas. So expect to see a rise in oil prices, once again potentially affecting global GDP growth, while at the same time increasing inflation. And keep in mind that inflation has already been on the rise around the world. Here in Australia, you've already seen rising fuel prices and rising food prices in the supermarket. So how has this played out in stock markets around the world? Well, first of all, keep in mind that last year was an exceptionally good year in stock markets. The MSCI World Index returned around 25% for an Australian investor, and the ASX 200 returned just over 17%. They're excellent returns. But ever since the start of 2022, markets have come off those highs. In the US, the S&P 500 is pretty much hitting correction territory where it's down by around 10%. We don't know what the markets will do tomorrow, but for all we know, the markets have already fully priced in the effects of the conflict, and markets will now go along their way, either up or down. Look, a major risk event like this normally sees investors rushing back into bonds. That's the flight to quality. Also, if it's going to be lower global growth, you'd also see that yields in bonds go down, bond prices go up. But inflation has the opposite effect. With inflation, yields have been going up, pushing bond prices down. So the bond market reflects these two opposing forces. And here you can see the Australian and the US 10-year bond yields, and you can see they've been on an upward trajectory. And while they wobble a little bit in the last few days with news of this conflict, their trajectory seems to be the same. In other words, the bond market are looking through the Russia-Ukraine conflict and saying that we expect the path of interest rates and inflation to pretty much win out here over slower economic growth. So what does this mean for investors and an investment portfolio? You know, given the difficulty in timing markets, when it comes to geopolitical events, investors should always stick to the appropriate long-term strategy that they had in place before this event happened. Geopolitics rattling markets is nothing new. However, the impact tends to be short-lived. Remember, over the last 30 years, stock markets have rewarded investors by sticking to their long-term strategy through all sorts of crises, both domestic and global.
On behalf of the War Hunt team, I'm Steve Garth.